Hi, and welcome to the Knowledge of August Tax Roundup. We're here to keep you stay updated and stay confident. This month, we're starting with the recent decision on trust distributions that raises some important considerations for trustees. We'll also take a closer look at a new ATO guidance on its website that clarifies interest deductibility for rental properties, a key area that continues to attract attention in audits. And finally, we'll also share some practical tips and reminders on the main residence exception to help you navigate common pitfalls and make sure that your clients make the most out of this concession. Let's get started.
So, Amy, the ART has recently handed down a decision dealing with trust distributions, which raises an important issue. Can you provide us with a summary of the case and the key issue that was addressed?
Yes, we all know that trustees of discretionary trusts are required to make a valid income distribution resolution by 30th June each year, unless a trustee requires an earlier date. So if there's no valid resolution and there's no effective default clause in the deed, the trustee will end up being taxed under Section 99A of the Tax Act. And that means top marginal tax rates, no CGT discount, and only limited access to imputation credits. Now, in this case, Goldenville Family Trust case, over a few years, the trust had about $7 million in income flowing through it. Now, the trustee claimed that much of this income was interest income and it was distributed to non-resident beneficiaries. Now, if correct, these will have attracted withholding tax on the interest rather than full resident tax rates. The ATO challenged the validity of these distributions, and they argue that the trustee had not actually made the resolutions by 30th June. And if that's true, the distributions to non-residents were not valid, which means that the income was instead assessed to the default beneficiaries, and in this case, they're Australian residents at resident tax rates. So the tribunal went into the evidence, and they're not convinced at all that the resolutions were genuine or made in time. They looked at when the trust accounts and tax returns were prepared and when the minutes and resolutions were signed and whether there was any real-time evidence of a 30th June decision. Now, with this case, a few things that stood out. The resolution supposedly signed on 30th June, they were perfectly matched the income figure in the tax return prepared months later, which suggests that the decision was likely made after all the numbers were finalized. And also in 1 year, there were 3 signed copies of the 30th June resolution with different signatures on them and no explanation. And in this case, the sole director of the trustee company had literally no involvement with the trust, acting instead under instructions from a shadow director. So basically, the tribunal concluded that the paperwork was reconstructed after the fact and that the decisions were not actually made by year end. The trust distributions to non-residents were found to be not valid, and the default beneficiaries were assessed instead. So just note that the ATO actually said that in this case that it's okay if a trustee holds a meeting on 29th or 30th June, makes a decision, and then make a note or record of the decision, even if the formal paperwork gets tidied up or finalized a bit later. But what they're not fine with is trying to recreate decisions later down the track and then pretending that they actually happened on or before 30th of June. So in this case, a lesson is to make the decision on time before year end, create real-time evidence of it, especially for sole director trustees where basically everything hinges on that resolution being properly made by year end.
Are there any other important lessons that we should take from this case?
Yes, the second issue in this Goldenville Family Trust case is about whether what was being called interest income was really interest at all. The trustee had labeled part of the trust income as interest, which was important because if that characterization was correct, it will attract withholding tax when distributed to non-residents rather than the full resident tax rates. But both the ATO and the tribunal, they were not convinced that this income truly was interest. What the tribunal did here was take a step back from the labels on the documents and focused on the economic substance of the arrangement. They found that despite what was claimed, there wasn't enough evidence to show that this was a genuine loan earning interest. Now let's look at why. Basically, there was no formal loan documentation, not properly executed loan agreement, no contemporaneous paperwork to prove the terms. The financial statements did not clearly reflect the claimed loan arrangement, and the tribunal found it implausible that someone would lend such a large amount to a person they barely knew without proper documentation. So, in fact, the tribunal concluded that this was more of a reconstruction, a narrative put together later to achieve a more favorable tax treatment. So, this is a really important lesson. The ATO will always look beyond the labels and test the economic reality. Just because something is called interest in a tax return doesn't make it so. It's also a good reminder of the risks around relying on backdated or incomplete paperwork if there is no clear contemporaneous evidence of arrangement, especially when related party loans or trust distributions. You got to be aware that there are high risks involved. Now, at Knowledge Shop, we often get asked by our members whether the ATO really checks this level of detail. So now this case is a perfect example to show that yes, they do. They will review all the evidence, the data, look at signatures, and test the possibility of the arrangements in light of the facts if necessary. So the takeaway here is simple but very important. So make sure that any loan agreements resolutions are properly documented at the time the arrangements are made. And don't rely solely on journal entries to evidence the transaction, and always make sure that the paperwork tells the same story as the economic reality. And the ATO has released some website guidance for practitioners on apportioning interest deductions for clients with rental properties. What are some scenarios where interest expenses should be apportioned?
Thanks, Amy. So the ATO has highlighted 4 main situations where an apportionment of interest would be required. So where there's a co-ownership of the property, where part of the mortgage has been increased for private purposes, where there's private use of the property, and where the property is only rented for part of the year. So for co-ownership, the starting point is that deductions are claimed in accordance with each person's legal interest. So for joint tenants, that means in equal shares, for example, 50-50, while for tenants in common, then it follows the documented ownership split, which doesn't necessarily have to be in equal shares. So for example, 20-80 or 30-70. The only exception is if there's a separate legally enforceable agreement that says otherwise. In that case, the interest deduction can be different to the legal ownership split, provided that it reflects the true liability for the repayments. A common example that we see is where a client's bank or lender might require them to include another person, such as their spouse, on the loan. The ATO on this recent website guidance has confirmed that if the other person has no other association with the rental property, then the client can still claim all the interest and expenses if they make a separate legally enforceable written agreement. The written agreement should state that the client is 100% liable for the loan repayments, interest and expenses, and should also be witnessed by a justice of the peace. This is in line with the ATO's other guidance in TR 93-32, that rental property income and expenses would normally be split between the owners of the property based on their legal interest in the property. Unless there's some other document to suggest otherwise, the ATO tends to assume that the legal and equitable interests are the same if the parties are related. Next, an apportionment of interest would be required for mixed-purpose loans. So if a client redraws on the rental property loan to pay personal expenses, then the interest needs to be apportioned between the deductible and non-deductible purposes. Once the loan has been used for any private purpose, then there's an ongoing need to apportion interest for the life of the loan. For this reason, it's generally recommended to have separate loans for the rental property and the private items. Thirdly, if the property is used privately, even for a short period of time, the interest for that period is not deductible. Similarly, if only part of the property is rented, so for example, one room of the home, you need to apportion the interest deductions based on the floor area that's used for the income-producing activities and also the period that it's used. You might also need to apportion the use of shared spaces like kitchens and bathrooms on a reasonable basis. Finally, if a property is rented for only part of the year because of renovation, sale, or owner occupation, then the interest deductions must be apportioned for that period. As a general comment, good record keeping is essential. So that includes keeping clear loan documentation, bank statements, and where relevant, a diary of the property use. Also, encouraging clients to keep separate loans for private and rental purposes can make life much easier and avoid apportionments down the track.
Thanks, Anne. The ATO has also updated its website guidance some tips for practitioners around the main residence exemption. Is there anything to note, and what are some common problem areas?
Thanks, Amy. So the main residence exemption can actually become quite complex to apply depending on the circumstances. One of the things that the ATO has confirmed here is that when you're completing the tax return for clients, it's necessary to disclose the full or partial main residence exemption at question 18 of the individual return. Even if the gain is fully disregarded, you still need to disclose the exemption under the question capital gains tax exemption rollover or additional discount type code. The ATO basically confirms that you need to answer yes to the question, have you applied an exemption rollover or additional discount, and then select Code I main residence exemption from the drop-down list. The ATO's data matching capabilities can pick up on when clients sell properties, so there's an increased risk of the ATO looking into a client's affairs if they notice a non-disclosure. This could trigger a more detailed review of the client's circumstances, so it's important that even the disregarded gain is disclosed to reduce the risk of the ATO questioning the client further. So the first thing to note is that the main residence exemption attaches to the dwelling. What this means is that where a client subdivides their property and only sells off the subdivided part of the land without the house, then there can be no main residence exemption on the sale of that land. Similarly, even if they plan to construct a main residence but end up selling the vacant land on its own, then the main residence exemption can't apply here. With respect to the cost base, under Section 118-192, if a client's main residence is first used to produce income after the 20th of August 1996, then the taxpayer is taken to have acquired the dwelling at the time it was first rented for its market value at that time. This rule applies automatically. So there would basically be a deemed reacquisition, and this resets the ownership date for main residence purposes too. So this new date would be when the property is first rented out and not at the end of the 6 years if they're applying the absence rule. If the gain isn't fully disregarded, then the client would generally also need to get a valuation of the market value of the property from this deemed reacquisition date. Clients can also only have one property as their main residence at a time. There's also a rule in Section 118-170 that if a taxpayer and their spouse each have a dwelling as their main residence during a particular period, they can only nominate one dwelling as the principal residence of both of them. And this is even if they do not have an ownership interest in the nominated dwelling. The other dwelling would then be exposed to CGT on disposal. It's also important to understand that if the client was a non-resident during the time that they owned the property. Importantly, the main residence exemption cannot apply at all if the taxpayer is a non-resident at the time of the CGT event, even if they were a resident of Australia for some of the ownership period, unless certain life events are satisfied. So non-residents that don't satisfy the life events test would not be able to access the main residence exemption rules, including the absence rule. And for completeness, while the CGT discount should be available if the property was held for more than 12 months, the discount percentage is also likely to be less than 50% if the client has been a non-resident for some of the ownership period. Clients should also keep clear records of how they use the property with dates if the property was ever rented out, as this can help to evidence or back up any claims when they're selling their property.
Thanks, Anne. Now, that's a wrap for this edition. We've covered the Goldenville Family Trust case about the importance of making valid trust resolutions, as well as the ATO guidance on rental interest deductions and the main residence exemption. These are important updates to keep your clients and your practice on track. As a member of the Knowledge Shop, you get access to our help desk, up-to-date work papers, CPD points, client newsletters, and all the latest technical updates. We deliver the certainty you need exactly when you need it. Thanks for watching, and we'll see you next time.